subscribe now and press the bell icon. Never miss an update.
Right, so we did this NQSOs or non-statutory stock option and all. They do not qualify for favorable tax treatment. Now, I think we didn't start with this. So now we'll go over ISOs, incentive stock option. Incentive stock option, one important thing to note is ISOs are given only to employees. Okay, but these ones, NQSOs, can be given to anyone, including a contractor or advisor or a lawyer, accountant, anyone. Okay, so there is that's why the tax treatment is also different. So when it is going to an employee who are working full time, that's where IRS says that they can go for better tax treatment. So an employee may not recognize income when an incentive stock option is granted or exercised depending upon certain restrictions. So at the time of grant, obviously no one is recognizing income, not even in NQSO, not even in ISO. But even at the time of exercise, we'll just go over it and see. The employee recognizes long-term capital gain if the stock is sold 2 years or more after the option was granted. That's a very, very important thing. You are resetting your clock to the time when it was granted. And what is and Tanya, what are we doing there for NQSO? What date are we picking up to calculate whether it's long term or short term?
The date she purchases, right? The options?
Date she exercises or purchases. Correct. So usually what happens is, like, if you think logically, the company is going to grant sometime, say 2022 they granted. They're not going to tell to employees or to anyone, hey, we are granting this thing, within a month you need to exercise. Whether you want it yes or no, just tell us. No, it doesn't work like that. Usually they give like 2, 3, 4 years of time that it is granted to you. If you keep working, if you're associated as an employee, maybe after 3 years they get vested, and then you can exercise them. So what happens, 2, 3 years just goes by, and then they get exercised, then they kind of then they get vested, then employees buy them by exercising their options. So the clock gets reset from that point of time. So whatever 3 years they were being granted for, those they don't count. But here the advantage is we can take our capital gain period from the date the option was granted. The employee recognizes long-term capital gain if the stock is sold 2 years or more after it was granted and 1 year or more after the option was exercised. So one of the employer is not allowed a deduction. That is fine. The excess of stocks FMV on the date of exercise over the option price is ordinary income when the stock is sold. So again, there is a difference here and NQSOs. When was Mary taking that extra $25,000 cost? Extra the $25,000 income as a wages income? At the time of exercise. At the time of exercise, she got 25,000. Like, she got extraordinary compensation of $25,000. Whether she sells it or not, W2 has been issued. $25,000 will be put up there. She has to pay taxes on it. Now in ISO, what happens is the ordinary income will come. We will still see what is the FMV and what is the date of exercise. So what is the FMV on the date of exercise and what is the exercise price and all those things. But it becomes income when the stock is sold. A lot of time what happens, if you look into it, and if you're talking about big numbers, that's what happened with Coinbase. The employees were there, they're like, oh yeah, this is really going to go high, let me exercise it right now and all. And then they may exercise by paying $1 million, $500,000 to the company. So when they're exercising it for $500,000, the price is fair market value is 1 million. That extra $500,000 gets taxed. And right now, what they've got? Only paper income. They don't have any cash in their bank account. It's a huge paper income they got of $500,000, but they have to pay tax right away. So the cash flow has to be managed. They got income, but it's all paper income. They get into the tax situation where the real money has to be paid out.
But will that be taxed as capital gain or ordinary
No. I'm
income?
talking about only ordinary income. I'm talking about at the date of exercise, it's only ordinary income. At the date of, we are not talking about capital gain or anything. What I'm trying to say is that there could be a kind of situation because they're supposed to pay taxes in non-qualified or non-statutory stock option. They're supposed to pay taxes at the time of exercise. So at the time of exercise, they don't get money in their pocket, right? They are just exercising it. They get the stocks in their brokerage account or demat account, if you want to call it in Indian terms. They see the value of that, which becomes 1 million. They're very happy. Oh yeah, I got something worth 1 million. IRS will come and say, well, you got something worth 1 million. Please pay us 30%. And when he has to pay $300,000, he looks into his bank and says, well, I have only $30,000. Where do I get another $270,000 from? So what they are forced to do, they're forced to sell the stocks right there. Just sell off at least half of that. At least get some cash so that the tax part can be covered. So they're forced to sell it unless they're sitting on heaps of cash and then they can use to pay the taxes. But here in ISO, they don't get any tax charged at the time of exercise. The tax will come only when the stock is sold. When the stock is being sold, obviously they're going to get cash in their bank. So they have enough money to pay. Okay, sorry, I think Tanya, you were saying something.
No, it's okay. I got it.
You got it, na? Okay. Yeah, sorry, I was like, I thought I'll just finish this off, otherwise I have to restart that.
So basically, in NQSO, on the date of exercise, that capital gain tax has to be paid, but here it is not paid. It is paid only during the stock sale.
I'm not even talking about capital gain. No, you're right.
No,
You're partly right.
sorry, in that the ordinary income, it is taxed as ordinary income, but here there is no taxation on that ordinary income part, correct?
Again, can you correct it again? Yeah, you're almost there, but not 100% right.
Okay, so in ISO, the difference between the purchase price and fair market value is taxed as ordinary income.
Mm-hmm.
Here, it is not recognized as ordinary income, right? Only when the sale happens.
You just said ISO. Okay, so again, you're getting confused. Both the cases, it has to be ordinary income. When did I say it is not ordinary income?
Okay.
Correct.
Yeah.
No, I never said it's not ordinary income. Only I'm saying is the timing of the payment of taxes is deferred to when you actually sell it off. Yeah, it's clearly saying even if it's ISO, the excess of stock on the date of exercise over the option price is ordinary income.
Okay. But you don't pay tax on it right away.
Huh?
But you don't pay any tax on it right away.
Exactly. You don't pay tax on it. You're paying tax when it is being sold. So that's so much convenient. Think about it. No? You're getting something worth $1 million on papers. You still have to, like, if it gets added to your W-2, you have to pay tax on it, whether you have real money in your bank or not. Where will you get that money from? I mean, it can create a big problem for the taxpayer.
Nitika, this year we have our client, Manjuri Krishnan. He got stock options in India, and as you are saying, he had to sell those stock at a loss of 22 lakhs.
Yeah.
To pay taxes.
Correct. If there's a risk as well. If the market suddenly falls.
And now the price is increased 50% of the cost. which he paid as ESOP. So like it's a big loss for him. Instead of gaining,
That's
he
why it is
lost.
very important for them to even do the planning. Shall they exercise it or not? It's not like, okay, something is giving, you are getting something from the employer. Okay, there's a very little cost to you, or maybe there is some cost. I mean, we just take it. No, we have to still do all that calculation. Does it really make sense? Or maybe the markets may go down. Maybe the company is really, really doing good. But if we can see the market falling down, the stock market, then maybe don't exercise. Maybe like let's wait for some time. But again, the employees or vendors may get into that situation that they're not left with any option but to exercise. Why? Because they may be expiring. So now they're like have to make a decision. Either I take those or I let them go. Sometimes they'll think, okay, let me just take that. At least the company is doing good and all. But suddenly the stock market falls down for some other reason. There is a war. There's this Adani news. The markets all fall. Nothing to do with their own company. But they get into that situation, and this has happened a lot in 2006 7 in US, when the entire economy has collapsed because of those the subprime mortgage thing and all. If you know about it, the entire Lehman Brothers and all, everything, like, had collapsed big time.
Yeah,
It
home
was
loan.
very common for people to file bankruptcies only because of stock options. They exercise all that when the market was at its peak, but they could not sell it. And when they wanted to sell it, it fell down so much that it all went underwater. So, like, so many people filed bankruptcies that time. I mean, no, I very close family friends of ours also, they filed bankruptcy only because of that stock option situation. There was no money to pay to IRS, and why would IRS, like, I mean, IRS says we don't care what happens, you just pay us our tax. So that's a very tricky situation. It doesn't happen every now and then, but that was a very exceptional year when it all fell down. So it's kind of risky as well. So one needs to be very prudent in analyzing what to do and not, and especially take into account the tax situation. You can still sit on the losses and you can think that, okay, let me recover it, like, someday it will go high and all. That is still okay. But when you are into loss and on top of that IRS comes and says that, okay, pay us taxes, that's a double-edged sword. No, one hand you're incurring losses, but you still have to pay taxes because of the difference in fair market value and an exercise price. And that time the fair market value was high, but maybe you didn't sell the stock in time. Maybe you thought, okay, I'll do it after 2 3 4 months, and suddenly one day it fell down. So you ended up paying so much of tax, and now those the same stocks are in losses. So that is a very common situation. It has happened. It's not like a theoretical situation. It has really happened, like, those times in US. So okay, so we'll just go ahead with this thing. So again, this is a favorable tax treatment, because one is that we can recognize the long-term capital gain period from the date the stock is granted. No, sorry, 2 years from this. If the stock is sold 2 years or more after the stock option was granted, and 1 year or more after it was exercised. And again, the ordinary income will come. There's no way to get away from it, but at least you don't have to pay taxes right away. You can wait until it gets sold and then you pay the taxes. So there are two situations here. In this situation, when there is only long-term capital gains and all, the employer is not allowed a deduction. In this situation, the employer may deduct this amount. The gain realized is short-term or long-term capital gain, depending upon if they are satisfying this condition or not. But what we are focused right now on, the taxation of individual, and not taxation of or deductibility on the employer side. You can still remember this: the employer is able to deduct this amount, but we need to properly understand the taxability on the recipient side, on the employee, on the individual side, not on the company right now. Non-qualified stock option, again, an employee stock option is not qualified. It does not meet technical requirements to be an incentive stock option. ISO can also have a NQSO and all. Okay, but don't get confused here. ISOs will go over this thing later. But an employee stock option is not qualified if it does not meet, there are a lot of technical requirements. So we have to, so first of all, when we are trying to understand the taxability of stock option, we need to first understand whether they are qualified, whether they are non-qualified. And usually this ISO things have become rare and rare nowadays because there is a lot of responsibility on the companies. So what they're saying is like there's a lot of paper, like I mean those filing requirements and audit requirements and all that the company has to go through. So maybe what it's just for their own ease, they may say that okay, we have stopped giving ISO, we will just stick with NQSOs. And that is what is happening. Actually, a lot of companies are getting away from ISOs. So an employee stock option is not qualified if it does not meet numerous technical requirements, whatever. If the options FMV is ascertainable on the grant date, employer is allowed a deduction. Okay. If there are certain technical requirements which are not met, then they are obviously not considered to be ISO. And in this case, they are being taxed as if they are these ones, non-statutory. Because what is happening is we are seeing what is the FMV on the grant date, and we have to take that income, gross income between the FMV and the option. Employer is allowed a deduction. There are no tax consequences when the option is exercised. No. This is not right. If it does not meet numerous technical requirements to be incentive stock option, the employee has gross income equal to FMV. Yeah, so there has to be tax consequences when the option is exercised because there is a gross income. Okay, wait, I think we'll just go over this example then it will be clear. I think the focus is on FMV is ascertainable. Let's look into that, and FMV is not ascertainable. Okay. Yeah, so if the FMV is not very clear, then they're following this thing that the employer, the gross income is there and all, and at the time of exercise is not there, and then capital gain. Capital gain part, this is common part. Whenever the stock is sold, there will be a capital gain. Only thing which is differing is when will the ordinary income be taxed. If the options FMV is not ascertainable on the grant date, the excess of FMV over the option price is gross income when the option is exercised. Okay, so at the time of exercise only, you'll have to put that up as income. Again, this is all happening if this is a non-qualified stock option. There are certain technical requirements, meaning there has to be a proper plan in place. There has to be certain more conditions that need to be fulfilled. And if the employer is not able to fulfill those conditions, then automatically those ISOs, they turn into non-qualified stock option. So the tax consequences are different. And this is the reason we will not see a lot of ISOs when we do the tax returns. Most of the time, 80% of the time, we will see only non-statutory stock option. But and then ISO, what happens? The AMT also comes into the picture. AMT is like the minimum tax, the alternative minimum tax, and that also needs to be calculated in ISO. They're not talking about it right now, maybe in some next chapters and all. But let's go over this example. This will make it clear. So who wants to do this? Honey?
Yes, ma'am. On July 1, year 1, Mighty Inc. Granted Henry an incentive stock option to purchase 2,000 shares of its stock for $40 a share. It's
Right, let's
FMV.
write it down. Huh? Let's write it down, all of you. Like to 2,000 shares. Year one, they have been granted. So the grant is happening on July 1st, year one, for 2,000. Okay?
Shares at 40 per share. It's
40
FMV.
per share. Yeah, for the next 5 years, they have this option.
Yes, ma'am. On September 18, year 2, Henry exercised the option and paid $80,000 when the stock's FMV was $53
So,
a share.
right. Let's stop. Let's stop again. Again, please write it down in your notes. Year two, on September 18th, he has exercised. So what is the difference between year, like July 1 to September 18th? It's more than 1 year. Right? So he
Yes,
has
ma'am.
exercised and he paid, how much he paid? 80,000. Why would he pay 80,000? Why would he pay 80,000?
40 per share into 2,000 share.
Very good. 2,000 per share times 40. So he's paid 80,000 because that was the price given to him. That time the FMV was 53. Please
53.
again you need to write it all this down because you will need all the numbers properly in order to calculate the taxability.
26,000.
Okay, next.
On November 23, year 3, Henry sold the stock for $124,000. Mighty Inc. receives no deductions upon grant, exercise, or sale. Henry reports a long-term gain of $44,000.
Okay, so what is the condition that Henry is satisfying here so that everything is coming up as long-term capital gain to him and there is no ordinary income at all? Honey, explain that, or anyone there, like maybe Vinita, Muskan, you guys can also help.
Ma'am, if like the condition is if the stock is sold 2 years or more after the option was granted, and or after 1 year or more when he exercised, so that will be counted as a long term.
If the stock is sold 2 years or more, and okay, this is not choice, and 1 year or more after the option was exercised. So when was it granted? Again, give me your dates, what you have written down. When was it granted?
July 1.
Granted July 1.
Year one.
Yes, ma'am.
Year is very important. Please put year also. July 1, year 1.
Yes, ma'am.
When was it exercised?
September 18, year 2.
September 18th, year 2 is exercised. When was it sold?
November 23, year 3.
November 23, year 3. So what is the difference between granted and sold? Is it more than 2 years?
Yes, ma'am.
Selling price and granting, selling date and grant date, is it more than 2 years?
Yes,
Yes,
ma'am.
ma'am.
Okay. And is it more than 1 year?
Yes, ma'am.
From the time of exercise to sale,
Yes, ma'am.
right? So he's satisfying this condition.
Yes,
Yeah.
So this is such a beneficial condition that everything is coming to him as a long-term gain of 44,000. Okay, now you need to help us understand, honey, how is the gain of 44,000 coming?
This is a difference of $80,000 and $124,000 in a simple way. And if you want to calculate in number of shares, so there is $13 difference per share into 40,000. But just a second.
2,000, because the total shares we are talking about is 2,000.
Yes. But then that will be 26,000 only.
Long-term capital gain will be EA sold sale price and then expensive.
So he exercised, or we can clearly see here, he exercised for 80,000
Yeah.
for 124.
Yeah.
So the gain is $44,000.
And so how much tax is he paying here?
15%, that is $6,600.
Right. Now let's look into another situation. Yeah, go ahead.
if Henry had sold the stock for $124,000 on April 15, year 3. That means before, the 1 year is not completed from exercise date and the sale date. So it is not complying one situation, one condition.
Correct. So that the one condition is still satisfied, that is it
No,
2 year from the
both
date of
conditions are
grant?
not. No, actually, that is also not holding good, because it's
Oh,
July
because it's
first
July.
year.
Right, it's
Yeah.
July and he's selling it in April only. Correct. So that 2 year is also not satisfied. And then when is he exercising? September 8th, 18th.
So both the conditions are not satisfying.
Only he's selling, and then he's selling it in April 15th. Right. So both the conditions are not satisfied. Yeah, go ahead.
So the special 2 year holding period would not have been met. As a result, Henry would have had $26,000 of ordinary income and $18,000 of long-term capital gain in year 3, and Mighty Inc. would have had compensation expense of $26,000.
Yes. So why the company will have compensation expense? Because the employee is having compensation income. So
Yes.
both of them are current account items, or income and expense items. Here we are talking about capital gains, and also when there are capital gains in capital gains earned by the employee, their company does not get any deduction. But when there is ordinary income earned by the employee, company also receives a deduction. What they're saying here, the entire income is, so what IRS is saying, we are anyways giving your employee a very good deal by taxing them only 15%. There's no ordinary income here at all. We would have loved to tax them at 30%, but we are not doing it, or 25%. So now you want us to tax your employee at 15%. At the same time, we should give company a deduction also. So that's not a good deal. I is saying it's not a good deal for us. Sorry, we cannot do that. Company will not get any deduction in their P&L for this item. You cannot take any expense for that. But your employee is getting, a very good rate of income tax. Here, the employee is not getting that, because the employee is not ready to hold on to for 2 years or 1 year. They're not satisfying the condition. So then there is $26,000 of ordinary income. Now we'll look into it. How did we come to 26 and 18,000? But there is some portion which is coming as ordinary. There's some portion which is coming as long term. And Mighty Inc., the company or the employer, they are able to take a deduction of $26,000. Okay. Now, honey, Vinita, try to explain how did we come up to 26,000 and 18,000 and all.
Ma'am, 26,000 is 53 is the FMV on the
2,000.
Go ahead and tell to everybody. Please explain, Vinita and honey, both of you.
Yes, ma'am. So, ma'am, the FMV on the exercise date is $53, and the that FMV on the grant date is 40. So the difference will be $13, and $13 into 2,000 will be $26,000.
Okay, wait, hold on. So, Bhavani, are you able to understand?
Ma'am, I did a different calculation.
Okay, you tell your calculation.
Second year, 53 per share, 53 into 2,000, that comes to 1,06,000.
Sure.
And first year's is 80,000, that is 2,000 into 40 per share.
Okay.
So the difference between 1,06,000 and 80,000 comes to 26,000.
Perfect. Both the approach are fine. We are anyways getting to the same number, right? Very good. Next, Vinita, go on. How do we get long-term capital gain? Jane can explain how do we get long-term capital gain. Wait,
Ma'am, can I say?
I mean, 44,000 plus 26,000.
That is actually the difference between sale price of 1,24,000 minus the cost which is coming to $1,06,000.
Right, right. So it's $106,000 is the new cost basis now, right? After adding $26,000 of ordinary income, but it is getting sold at the same price. Selling price is still same, 124 only. So the difference between the two will become 18,000 of long-term capital gain. While long-term now, again, we can see it's when it is being sold and when it is being bought. I think when did they buy it? When did they buy it? Wait a minute.
Yes, ma'am. Ma'am, it will be like the exercise date, September 18.
Okay. What September 18th, year two. No, but
Yeah.
one is buying in they're selling in year three.
Yes.
So how come it became long term then?
Ma'am, because we are taking the date from the grant date.
Right. So what they're saying here is, if both the conditions are satisfied, then it is all long term capital gain. If it is not satisfied, a part of the income is short term, obviously FMV, but still because this is ISO, we can still go back to the date when it was granted, and from there we're gonna calculate the date of the sale. Okay. So this is how we come to 18,000. And let's assume that their rate is like 25% for ordinary income, 15% for long term. So the total tax is coming to $9,200. So in this situation, if the employee is not holding it for 2 years and 1 year and all, there's his end income paying 2.6K more than the regular tax. But it is still beneficial because, I mean, as compared to the non-statutory stock options. Why? Because they're able to get 18,000 of long-term capital gain. In non-statutory, we have to count the days from the date of exercise. Clear?
Yes, ma'am.
So this is the situation one. These are the dates, sold date and all.
Let me
Okay.
explain it like this in detail to everybody so that
Okay.
it's clear.
So on July 1st, the option was given at the rate of $40 per share for 2,000 shares, which was not exercised in July 1st on the first year. Second year on September 18th, the option was exercised. At that time, fair market value was $53 per share. But since these are ISO, it will not be taxed as ordinary income at the time of shares exercised if these two conditions are satisfied. Even if the conditions are not satisfied, it will not be taxed. So we will just calculate what is the cost and what is the ordinary income would have been if it is not ISO. In that case, 2000 shares, 53 is the fair market value, 40 was the cost. So the difference between fair market value in totality, which is $106,000, and the amount which the employee is paying is $80,000. 26,000 is the income. If these shares would have been non-qualified stock options, this 26,000 would have been taxed in second year as ordinary income itself, but it is non-taxable. Now, on third year, on November 23, these shares are sold out when the market value was $62 per share and cost was $53, which we have got from the second year, and the total gain is $18,000. Normally, it would have been taxed as capital gain, but here it will be taxed as capital gain if these two conditions are satisfied. Total income, total gain is $44,000, ordinary gain and capital gain. Now we'll look into the condition two. whatever two conditions are there, and both should be satisfied. First condition is period between grant and exercise. Is it grant and exercise, Nitika, or exercised and sold? The condition one is period between grant and exercised should be more than 1 year. This is correct, no?
Yes.
Okay. So this condition is satisfied because it is 14.5 months. Period between exercised and sale, that is holding period, this should be more than 2 years. This condition is also satisfied because the period is 2 years and August, September, October, November. Yeah, 28 months. So these both conditions are satisfied. Hence, since this is ISO, both the conditions satisfied and entire income is taxable as capital gain. So the benefit is 26,000, which would have been taxed at ordinary rate, excess the highest rate, that is also taxable as capital gain rate, long-term capital gain. But the second situation, if the shares are sold on April 15th of the third year, rates are same, everything is same. The period between grant and exercise should be more than 1 year, that is satisfied. But the period between exercise and sale should be more than 2 years. This is not satisfied. It is short
No,
by.
no, no. I think the period between grant and sale should be 2 years. Wait, the second point, period between exercise and sale, no. Period between grant and sale.
Is it?
Yes.
Okay. Period between.
See, let me read it again.
Ah.
Employee recognizes long-term gain if the stock is sold 2 years or more after it was granted. So the difference between grant date and sale date has to be 2 years.
It should be grant and sale.
Okay, the sale should happen after 2 years it was granted. And exercise should happen after 1 year. Sorry, the sale should happen 2 years after it was granted. Okay. And the difference between exercise date and sale date should be more than 1 year.
Between sale
So between grant and sale should be 2 years. Exercise and sale should be 1 year or more.
Okay. Sale and exercise. So sale and exercise here is 14 months. Okay. And grant and sale is 28 months.
So both the periods are compared with the sale date only. Grant se sale tak kitna hai, and then exercise se sale tak kitna hai.
Here, sale and exercise is
that's very less, right? Because it got exercise only in September, and within 7-8 months he's selling it. He's selling it in April only.
10 months. So this is also not satisfied.
Jan, Feb, March, yeah, 9 months or 10 months, whatever.
This is also not satisfied. And grant and sale. Grant and sale is 28 months.
So grant, what was the grant date? July 1st, year 1.
Right.
Why is it 28 months? Because grant is July 1st now. So year 2, July 1st will be 12 months. Then year 3 is selling it in April only.
Right. I took these November wala.
It's 18 months, right? Not 28 months.
So this is also not satisfied. July to July and July. Yeah. Yes. July. It is, yeah. It should be more than 18 months. It is going to be around 20 months. Whatever it is, but not satisfied. Hence, whatever is the ordinary income, that will be taxed as ordinary income, and whatever is the capital gain, that will be taxed as capital gain. This 26,000 and 80,000 split will continue. Employee will not get this benefit of taxing everything at the rate of capital gain rate in condition 2.
Right. Okay. Sorry.
So both the time we need to compare with sale only. Sale and grant, sale and exercise.
Correct. Okay, good. So we have seen what are NQSOs, we have seen what are ISOs. We have to, the moment we see a stock option kind of gain, we need to first understand what kind of stock options are those, and are we are we following the rules? Okay, if there are, most of the time you will see non-statutory stock option, which is very, very simple. At the time of exercise, we see what is ordinary gain, and then at the time of sale, we only worry about capital gains. When we see incentive stock option, we have to immediately understand that these will give better benefit to employees. So we'll probably have to, see if the employee is waiting for 2 years from the date of the grant or 1 year from the date of the exercise, is holding on for those 2 periods, then you may actually get complete income as long-term capital gain income. If it's not satisfying that condition, because there is no such thing, there is no restriction placed on those stocks that you cannot sell it for next 2 years and all. If the employee needs money, he may think of selling it, or if he thinks that, oh, the stock price will definitely go down, let me just sell it off, then maybe it's a wise decision to sell it and report some income as ordinary income and pay ordinary tax rate on that. Okay. The good part is that both of those income will come in the year of sale. That is a good part. In NQSOs, non-statutory stock option, what happens is whether the sale has happened or not, IRS is not concerned about it. As soon as they exercise, they're like, okay, pay us our tax. In the terms of, for ISO, IRS is ready to wait until you sell it. If you're not selling it for next 10 years, 20 years, 30 years, just sitting with you, you don't even have to pay any taxes. Okay, so that's again an advantage. Okay, and when does employer gets a deduction? So if everything is coming up as capital gain to employee, then IRS will not give deduction to employer. So employer also keeps a record of what is the time when they were granted the stocks, what is the time when the employees exercise those stocks, what is the time when they sold those stocks. Employer also has to maintain all those things. It's not like once the stock is exercised, employer has no idea. Okay, we don't know, employee took that stock, we don't know whether it's sold, not sold, what they're doing with it. So they have full employee portal and all, where all this information will be there. How much you got on what date, what is the grant date, grant price, and all those things. So employee comes to know whether they have been sold, employer comes to know whether they've been sold or not. And if the employee is not like getting full benefit by reporting 100% of income as capital gain income, if the employee is not able to satisfy those conditions, then a part of that total income becomes ordinary income, where employee is paying highest tax rate. So when the employee is paying highest tax rate, employer goes to IRS and says that, hey, my employee is paying highest tax rate, give me a deduction. You're getting more taxes. Let me also take that deduction in our books. And in that case, IRS says, fine, you can take a deduction. Because at least they're getting some, tax revenues as ordinary tax revenues, not the capital gain tax revenues. So now there is another thing called employee stock purchase plan. Very commonly, they're called at ESPP. We will see this again a lot. We need to understand the moment somebody says ESPP, you should understand that these are stock purchases, employee stock purchase. That means there is no option given here. Employer is not giving any option to do anything, whether you want to buy, you don't want to buy, all those things, nothing. Employer is simply saying, see, there is a plan that we'll put in. You can go ahead and straight away purchase the stocks from us. It's called stock purchase plans. Now, employee will say, why should I purchase it from you? What is the benefit? I'll go on stock market. If I'm working for Apple, why will I purchase it from you? It's being listed on NASDAQ. Let me go there. I'll purchase it. Maybe it's trading for like $200, whatever, I'll purchase it there. What does the employer say? Well, yeah, you can go ahead and purchase it, but if you get it from us, because you are an employee, we'll give you 15% discount. Right? Straight away, like you'll get 15% income. If it's whatever, trading at $100, we will give you at 85 only. That makes sense, right? That would make sense. Otherwise, why would the employee can buy it from anywhere? It's all publicly traded stock. Go ahead and buy it from stock market. Why do you want to take it from employer? What is the fun in doing that? What is the motivation for employee? It's because employer is saying we will give you 15% discount. But that 15% discount is a kind of perquisite or benefit given to employee. So at some point of time, IRS will come and say, hey, you are giving a 15% discount. You're giving some kind of perquisite to your employee. We have to make sure that we get tax on that 15%. But when do all these things happen? What the timing is important here. Okay, when does it become taxable? That's what we'll need to understand. So generally, what is this ESPP? Is generally the employer gives permission to employee to buy stock at a discount. Option, I mean, don't get confused with this word. They're still using option, but then whatever stocks issued under an employee stock purchase plan, they qualify for special tax treatment. What is it? Now we'll see. No income is recognized under such a plan at the time the option is granted. Again, this when they're using the term option, is they're saying that option to purchase these stock plans. So again, that also gets bit confusing. We need to understand it's not like employer comes every year, say, hey, you get this 100 stocks as part of your ESPP. If you want to buy, you can buy them at 15% discount. Okay, otherwise they're expiring right away. It's not like that. They always give some time to employee that, okay, the hundreds are, you have a choice. You can buy them, still you will get 15% discount. Maybe this period is valid for 6 months. You make your decision. Or maybe this is valid for 1 year. Whether you want it a discount or not, make your decision. But the prices are frozen at the time this ESPP plan is put up. So employee, the flexibility is given to employee because from the employer side, prices are frozen, right? Prices are frozen that, okay, will, at the time when we put up this ESPP plan, the fair market value was 100, you can take it at 85 and you have 6 months to decide. After 6 months, maybe the stock market crashed and maybe the stock itself came down to $80. In that case, does employee want to buy it at 85? Anurag, would employee want to buy it at 85?
No.
No, right? That's very easy for anyone to understand. Why will they buy it at 85? When the stock market there, you can just simply go there and buy it at 80. So in that case, employee may say, well, yeah, good that you're giving me at 15% discount, but the situation has changed in the next 6 months. So I don't want it. I'm not going to buy it. And the other side is in these 6 months, maybe they have frozen the prices at 185 and the stock went up to 120. Employee can still get it at 85. And now the stock is trading at 120. That's a big gain. I'm pretty sure employee will say, well, yes, I definitely want to buy it at 85. Why? Because straight away he can buy it and go and sell it and make money. So, okay, so the no income is recognized at the time the option is granted. That means that 6 month period they are given or 1 year. I'm just giving an example of 6 months. It could be 1 year as well. That no option is granted. No income is recognized The recognition is deferred until stock acquired under the plan is disposed of. This is again very good thing, because here again IRS is ready to wait until the date of disposal. Even if, okay, now the stock is at 120, what employee after 6 months, 6 months that plan, like that employer is saying, well, if you want to buy it at $85, you have to buy it now. I mean, 6 months are getting over today. It will, like, we will not give any more at $85. Employee immediately goes and exercise that and saying that, okay, give it to me at 85. He is getting it at 85. Fair market value is $120. Still, there is a favorable tax treatment. IRS is not coming and saying, well, you got something at a very cheap price, so you give us tax. If they were non-qualified stock option, IRS would have done that. But here also IRS is saying, okay, good, you're getting something at low price, fine, we don't care. Keep it with you. But when you are selling it, that time we need a tax. So that's again a good situation, because first of all, you're paying money out of your own pocket to buy the stocks. And then even if without selling, you have to pay taxes also, it's just money going out and out and out. Right? So like it may create problem with the liquidity. So it is, again, it's a good, they are qualifying for special tax treatment. It's a good thing. So what happened, what we need to remember here is ESPP taxation will come to the picture when they are being sold. So if you receive a 1099 when you're working on the tax and you receive a 1099, let's say the taxpayer is working for Microsoft. And in the 10, you see the W2 is from Microsoft. You are 100% sure this person is working for Microsoft. You receive a 1099, say from Fidelity. And there you see, hey, this person sold 100 Microsoft stocks. His employer is also Microsoft. And this person is also selling off Microsoft stock. Immediately the idea should come in our mind. What kind of stocks are those? Are those NQSOs? Are those ISOs? Are they part of ESPPs? How do we take the tax treatment? You would probably look into W2. If there is an ordinary income, it's being captured there. If you don't see anything in W2, then again you're thinking, what is it? Is it ESPP? Or is it ISO? Why is nothing being coming up in W2 as ordinary income? So again, this is very important. We cannot prepare a tax return just based on that 1099 which is given. A lot of times we ask for supplemental information. We ask them, give us more details. We don't understand what are these 100 stocks that you are selling. You work with Microsoft. Your employer has given these stocks and you're selling them. We definitely need to understand what kind of stocks are those, under which plan you got them, and for how much time you are holding on to them. When were they granted it to you? When did you exercise them? We can actually see the sale date in 1099, but we don't know when did you exercise them, when were they granted to you, what were the prices when they were given to you. We need to know all the history about it. Maybe we'll have to go back 5 years, because maybe they were given 5 years back. They were granted 5 years back. We'll have to go back 5 years. We'll have to tell them that give us all these your details. When were they given? And maybe they are like 2017 stocks. They're part of 2017 stocks which were given, which you're now selling in 2022. Then the entire cost basis has to be changed. We have to go and look into the 2017 lot, understand the entire thing, and then come up with the correct calculation of ordinary income and capital gain income. But when the person is working for Microsoft and you see in his 1099, he's selling Apple stock, does it matter? No. I mean, like, unless there is a history that the person has worked for Apple also. But for our simplicity, we are going to assume this person has never worked for Apple. That means these are just general stocks. He must have bought it like on stock market. He's now selling it. Those are just general capital gains. They don't deserve any special treatment. Based on the holding period, we can just see whether they're short-term, long-term, and accordingly put them up in Schedule D. But these are all like, if you need to be, we all need to be aware when we are doing the return. We cannot just do it blindly. Oh, 1099 says Microsoft hundreds. Okay, just put all these things in 1099. Like, we need to understand what is going on there. You cannot just do blindly, just take the numbers and put in there. The thought should come to us. Why this guy is saying Microsoft stock? Let's look into his W2 again. The moment we see W2 from Microsoft, we should say, like, okay, stop here. Let's understand the entire thing. Okay, then only we'll put any numbers. And now to make it more complicated, if this Microsoft employee is staying in India, probably that income is already captured in his Form 16A. And it is also coming up in W2. That makes it more complicated. Now we have to again, use our mind to see, okay, now we don't want our client to be taxed on the same income 2 times. That would be a stupidity. So we'll have to understand then, when were these granted, what was the time you were performing services, what are these rewards given you for, which country will have the first right to tax you on. And accordingly, we'll have to make some adjustment in the tax return and make sure that, bottom line is, make sure they are not paying taxes 2 times on the same income. One of the country has to give them tax credit. India, US has a tax treaty. They're clearly saying that the person should not pay taxes in both the countries on the same income. Now, if we have to take a judgment, which country should he be paying the taxes from his pocket? Like, I mean, he's just going to have to pay to one country. We have to take a professional, judgment on that. Because if income tax department starts auditing, or they send a scrutiny that why this income is put up as foreign income, we should be able to explain why this is a foreign income. And even though it is included in Form 16A, why we think it belongs to US and not to India. Or vice versa. Even if this is reported as W2, lot of times we will take that as W2, but again we will put that as foreign income, saying that, telling it to US that, okay, no, you are issued W2, which is okay, but India has a first right to tax on it. So you consider that as foreign income. You give us the tax credit because this guy is already paying 45% in India on this income. Don't tax him again. So again, those all calculation, our work papers have to be very, very clear. All the dates need to be mentioned properly, because these all scrutiny will come 4 years, 5 years later. Who will remember what has happened? We can properly answer the audits or the scrutinies which happen. Okay, there are certain conditions. Obviously, there are certain conditions every time. So we'll just go over the example that will make it clear. But usually 85%, that 15% I'm saying, the discount, that is not flexible. It should not be more than 15%. So usually the stock option price may not be less than the smaller of 85% and all those things. So you cannot give discount of more than 15%. You cannot leave it open for unreasonable time. What are you saying? That, okay, within 5 years, employee has to make a decision whether they want it or not. Okay. And if any owners, they own more than 5% of the company, that means they are influential shareholders. They should not be given, these kind of schemes and all, because then they will be able to hold more and all. It's just that the IRS is saying that this is a benefit given to employees. In any given year, you cannot purchase more than $25,000 of stocks. So there is also a dollar limit that they've put in. This is meant to be a perquisite. It is not meant to just evade all your W2 income. Instead of putting 200,000 in W2, you'll say, oh, I'll put only 20,000 in W2. That all income will be through ESPP and all. So I will get that income. For next year, I will not pay any taxes. Why? Because I'm not selling it. All these manipulations can be done. So that's why IRS is saying, fine, you want to give like some perquisites to your employees and all those things. Give it $25,000 is a reasonable amount. You should not go above that. You cannot transfer all these things. If this right to purchase the stock is given to employee only, employee cannot go out and say to his friend and all, hey, I have a right to purchase this. Like, you pay me whatever, $5 per stock, I'll give you all those rights. And then you can buy it from my company. It's not like that. These are not transferable all. These are only meant for employees. You cannot do all those things with it. Okay, let's go through this. I think this is something we have put in. Let's just go through it. What it is saying, FMV at the time of grant is $100, buying price is 85, so discount is 15, selling price is 90. There is an ordinary gain of $5. Why ordinary gain of $5? Because the FMV at the time of grant was 100, so and the buying price was 85, so FMV was more than the selling price. Now the grant FMV is 55 and FMV on exercise is 60. Here the FMV has increased from 55, it became to 60. And exercising 50, I don't know, ordinary gain is like, I have no idea what probably when we did it last time we had something here, but wait, let's just go through it. So ordinary gain is 10 by 5. Okay, let's just do one thing. I'll finish it off. I think it's not completely written here. Let's just forget about that. We'll just go through this example. Okay, maybe this will help us understand more. So, Shweta, go ahead and please also explain this.
Alice was given an option to buy 200 shares of Delta Inc. stock for $55 a share when it was selling for $62.
Yes, let's everybody please write down all your numbers. If you don't write, you won't get it. 200 shares. Employee can take it for $55. That time the FMV was 62.
Okay. She exercised the option 2 years later when the stock was selling at 68.
Correct.
So selling price is $68.
Correct.
And sold the stock after another 3 years for $81 per share.
Right. So this is ESPP. First of all, let's understand when will the tax come into the picture. Year of exercise, year of
When the stocks are sold.
Exactly.
So she sold at $81 per share.
Right.
So date of
So we have to see now what was the fair market value at the time of grant and at the time of exercise. So at the time of grant, it was given the fair market value
was at the time of grant, and selling price is 81. So 81 minus.
No. Just first we'll have to see what are the FMVs at the time of grant. It's written somewhere here.
It's right above the example.
Which example?
Where the example is right above that only it shows.
Yeah, this one.
This
one you're talking about. Achha, this example.
Yeah, here only. See,
correct.
0.6.1.
The exercise price was less than the value of the stock upon grant. So what is the value of the stock upon grant? At the time of grant, what is the fair market value?
62.
Exactly, 62. At the time of exercise, what is the fair market value?
Exercise, it is 81.
68. 68. You're again getting confused. He sold it at 81.
Okay.
Now, at the time of sell, what is the fair market value? Obviously, 81.
81.
It's getting sold at 81. So we got 3 fair market value at 3 different dates. Right? Grant, exercise, sell. Now, what they're saying is we need to compare. See, we have to see whether the stock is going up or going down. At the time of grant, the stock was 62, it went up to 68, which is good, right, for the employee. What if the stock was at 62, it went down to 58? Why will even employee take it?
Right.
I mean, we have to first understand these two things, then we'll go to the next step. So what they're saying is exercise price was less than the value of the stock upon grant. The employee may have compensation income. So
Okay.
how much is our exercise
So
price? 68.
68 minus 62.
68, and it was value of stock upon grant is 62. The employee may have compensation income. So again, we are going to see, we have to see lesser because we want to give less income to employee. So we have to see this price 62 or 68, and we have to compare it with the price at which they have given him, $55. Okay, now we have seen three prices. Grant price is 62, exercise is 68, selling is 81. Okay, ये तीन price तो these are all market price. What is the price at which he was given the stock? 55, right? So it was selling for, what were we doing? Yeah, 55 is the price that employer gave them. So now the employee is still getting the shares at 55. So we need to see what is the lesser of 62 or 68. What is the lesser of fair market value on grant date or fair market value on exercise date, and then take that difference because that will become ordinary compensation.
Okay.
So between 55 and 62, that becomes ordinary compensation, which is like $7 per stock. How many stocks are there?
200.
200, whatever. So this becomes $7 times 200 is 1400 is ordinary income. Now we have to reset our basis. So he bought it at 55. We are already taxing him $7 as ordinary. So 55 plus 7 is how much?
62.
62. So now he's selling that at 81, he or she, whatever. She is selling it at 81. So we will do a comparison between the new cost basis of 62 and selling price of 81. 62 minus 81 is how much?
19.
$19 per share or whatever times 200 is like 3,800. That becomes the capital gain. And why long term? Because she is holding it for like a good amount of time, like more than, I think 1 year is the only thing here. Yeah, 12 months and all. There's no thing that they have.
Ma'am,
Yeah.
19 per share into 200 is not 38,000. 3,800. No, 19. Okay. Okay.
You got me confused.
I only
Seriously, seriously. And you said it with such a confidence. I'm seriously, I took out my calculator and started doing it. Bhavani, is that you?
Yes, ma'am. Then why they took like or 3,800?
Or meaning, okay, just leave that or. This is confusing, then just take it. Okay, 19 per share times 200, which is equal to 3,800. Is that okay now? There's no or and all. Okay. Clear?
Yes, ma'am.
What is the, okay, tell what is like the worst possible tax treatment a person may get? What kind of plan? And what is the best?
NQSO.
Huh?
NQSO.
And second best is what? Let's say all the conditions are satisfied, then what is the second best tax treatment? That's going to be ESPP, because again you are waiting for the date it gets sold. And the best possible tax treatment is ISO, because here if you satisfy everything, you can move entire gains to long-term capital gain. Imagine a person having, I mean, right now we are seeing only $2,000 difference. Imagine a person having like $5 million of stock income. Huge difference it will make on ordinary income and long-term capital gain rates and all. Or $2 million, $1 million, which is common. Like, I mean, people on very top positions, they may get those kind of stocks. Okay. So NQ, non-qualified stock option, will always have some ordinary element there. It is not the best possible situation, but it is most common. Second most common is ESPP, where there is, you can still wait until you sell the stock, but there is always some kind of ordinary element will be there, ordinary gain element, ordinary like income element. And the third, the best situation is ISOs, again, which is rare. Companies have stopped giving those because there's a lot of audits happen and all those things, more responsibilities on the companies. Since they are passing on the best tax treatment to employees, there's more onus on them to make sure they're satisfying all the conditions of the plan. So it has becoming rare and rare, but still there are a lot of companies who are doing that. And if the employee can wait for 2 years and 1 year, that condition, if they satisfy, that is the best possible treatment, because entire gains can be moved to long term. So if we should also be able to, if the client asks us like, I am having so many of these stocks sitting with me, what should I do? Shall I sell it? Shall I not sell it? We should be able to understand all that situation, and we should be able to give a proper advice that if you think the stock market will go high, what you should do. If you think it's probably saturated. The company stock will not go anywhere. It will stay at this level only. Or there is a risk it may fall down. Then, if you want to sell it, you better first look into your tax situation. Make sure we are having so much of money available for tax. Then we sell it. These are very common for all the tech companies, all the Silicon Valley companies and startups and all. Stock options are extremely common now. They are not meant for only big or small companies. Everybody is giving stock options. So we definitely need to understand, and it is becoming common in India as well now. That's as common as getting a W-2 for a lot of companies, for a lot of employees. Okay, this is an important part, and now I wanted to take some time here. The next chapter is going to be on dividend and all. We'll quickly skim through it. There's not much there, and those things would be easy to understand. Okay, so we'll just close it here now.